Good morning, venture capital. This is Metagame, and today's episode is about how invisible tracking systems are revealing secret billion-dollar investment opportunities hiding in plain sight outside traditional startup categories. $2 billion in venture deals happened last quarter that your Pitchbook filters completely missed. Not because the data wasn't there, not because the deals were small, because they were filed under a category you've been trained to ignore. Other. That's right. While you were running your neat little sector, searches AI/ML, enterprise software, fintech. The SEC was quietly collecting Form D filings for billion-dollar infrastructure plays, governance software consolidations, and consumer brands raising at tech multiples, all tagged with the most boring classification in venture capital. Other. And here's what makes this delicious. The firms that found these deals aren't smarter than you. They just stopped trusting the taxonomy. Let me give you the headline number. Crusoe, Inc., a Denver-based AI infrastructure company you may have never heard of, filed for $1.03 billion. That's billion with a B. And if you searched Pitchbook for AI deals, for infrastructure deals, for energy deals, you wouldn't find it. Because the SEC looked at Crusoe's business model and said, "We have no idea what this is. File it under other." Now, Crusoe isn't some obscure startup hoping the classification hides their mediocrity. This is a company that just secured a $300 million credit facility from Goldman Sachs collateralized by AMD AI chips. Let that sink in. They're using graphics processing units as loan collateral. When compute becomes an asset class with measurable residual value and liquid secondary markets, you're not in venture capital anymore. You're in industrial finance with cap tables. The structure is almost elegant in its circularity. AMD chips secure the Goldman loan. The loan proceeds, buy more AMD chips. Those chips power data centers in Ohio. The equity raise provides the balance sheet anchor that makes the whole credit structure possible. It's vendor-backed financing, meets project finance, meets growth equity, and it doesn't fit in any box your fund's investment committee has pre-approved. But here's where it gets strategic. Crusoe isn't building data centers the way hyperscalers do. They're partnering with Energy Vault to deploy modular units at 25 megawatts, starting this year with sub-12-month delivery timelines. At typical costs of $10 to $15 million per megawatt for AI-optimized facilities, that's $250 to $375 million in hard costs per deployment. The billion-dollar equity raise isn't about runway. It's about enabling project-level credit facilities at scale. And this matters because enterprise AI budgets, now averaging $124 million, according to KPMG's Q4 survey, aren't flowing to cloud credits anymore. They're flowing to dedicated inference infrastructure where latency, data sovereignty, and cost predictability actually matter. Public cloud economics don't pencil for sustained inference workloads. Crusoe knows this. The hyperscalers know this. The question is whether you know this. Now, Crusoe alone would be a story, but Crusoe isn't alone. Same quarter, same other category. Audit Board Holdco files for $330.2 million. Litera Holdco files for $386.6 million. Skims body, yes. The shapewear company files for $262 million, Form D signed December 19th. Added up, that's over $2 billion in institutional capital deployment, hiding in the miscellaneous bucket because business model innovation has outpaced taxonomic convention. Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai. Audit Board is governance, risk, and compliance software GRC for those who love acronyms. The holdco structure signals private equity involvement or structured recap financing. This isn't a Series C with cute terms. This is enterprise infrastructure capital at scale, positioned for a market where 67% of enterprises rate AI initiatives as recession-proof. If AI is recession-proof, the compliance software that governs AI deployment becomes mission-critical. Audit Board is betting $330 million that back-office infrastructure is the new front-office opportunity. Litera's $386 million positions them as legal tech's quiet consolidator. The holdco structure and deal size suggest either a major platform recapitalization or a multi-product roll-up. Legal tech sits at a weird inflection point. Enterprise legal departments are pressured to cut outside counsel spend, which drives software adoption while simultaneously facing AI-driven contract analysis disruption. Deals this size in other often represent strategic bets that existing category definitions fail to capture. Is Litera legal? SaaS? AI tools? Yes. And then there's Skims, a consumer brand raising $262 million through private offering exemptions traditionally reserved for B2B software. The LA-based company has achieved tech company growth rates, which apparently confuses the SEC as much as it confuses traditional consumer investors. Is Skims a product company, a DTC technology platform, a media brand with physical goods attached? The answer is probably all three, which is exactly why it ended up in other. Here's the pattern recognition that matters. These 4 deals share a common thread. They occupy definitional gray zones where traditional sector classification breaks down. Crusoe is AI infrastructure meets energy project finance. Audit Board is SaaS meets financial compliance. Litera is legal services meets software rollup. Skims is consumer products meets technology-enabled brand scaling. The other bucket isn't random. It's where complex capital meets category-defining opportunity. So what does this mean for how you source deals? If your partnership can model SaaS LTV to CAC ratios, but not power purchase agreements, interconnection timelines, or data center cost per megawatt, you're locked out of Crusoe category opportunities. The competitive gap isn't sector knowledge. It's whether your fund structure can accommodate deals that look like venture growth on the equity layer, but require project finance expertise on the capital stack. If you're only tracking Pitchbook-tagged deals, you're seeing these opportunities 60 to 90 days after firms with direct SEC filing monitoring. By the time Crusoe appears in CB Insights, the Series D is already priced and allocated. That information asymmetry compounds. The late money doesn't just pay more, it gets worse terms and less access. And if you're not making explicit bets on category formation, you're hoping clarity emerges post-investment. The firms winning these rounds are declaring theses. Legal tech is becoming enterprise software infrastructure. DTC brands at scale are technology businesses. AI infrastructure is project finance with equity optionality. Those aren't sector preferences. Those are structural views on where the market is heading. The risk of ignoring this trend is adverse selection. If you're systematically filtering out other because it doesn't match your mandate, you're leaving Crusoe-type opportunities to crossover funds, infrastructure PE, and family offices with flexible mandates. And as AI workloads drive capital into physical infrastructure, returns in pure software AI application layers may compress while infrastructure deals, higher capital intensity but lower competition, generate the alpha you're missing.
Oh, hey, friend. Do you like what you're hearing? Now you can have a ridiculously amazing podcast, too. Check out holler.studio to get yourself one today.
The opportunity is equally clear. The Crusoe AMD collateral structure opens a new financing playbook. If AMD underwrites $300 million in chip purchases via Goldman, what would NVIDIA do to secure long-term deployment commitments? What would Cerebras or Grok offer? For firms with credit arms or balance sheet capacity, originating vendor-structured financings could generate current income while building equity optionality. Remember that $2 billion number I opened with? The deals your filters missed? That's not a bug in the SEC's classification system. It's a feature of a market where the most interesting opportunities don't fit the categories we've been using for 20 years. When training a frontier model requires negotiating directly with utilities for grid capacity, when compute hardware becomes financeable collateral, when consumer brands achieve software economics through vertical integration, the old taxonomies stop working. The other category isn't where deals go to hide, it's where new categories are born. The question isn't whether you should be scanning it. The question is whether you've already lost the deals you'll never know you missed. That's our venture capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grep News. Thomas.